Hello. أعوذ بالله من الشيطان الرجيم. بسم الله الرحمن الرحيم. الحمد لله والصلاة والسلام على رسول الله وعلى آله وبارك وسلم. Assalamu alaikum, dear students. I welcome you all once again to another session of online video lectures for the subject financial statements analysis. Inshallah, in our today's lecture we'll start chapter 4 of this subject, which is the financial statements analysis methods. This lecture is lecture number 6 of the video series. So in our today's lecture we'll have discussion on the horizontal analysis and vertical analysis. Though this chapter covers 5 financial statements analysis methods, which are horizontal analysis, vertical analysis, common size analysis, index analysis and trend analysis. But inshallah, in our today's lecture we'll have discussion on horizontal analysis and vertical analysis. But before that, we will have discussion on the previous lecture, and I'll show you some formats of the financial statements, and we'll show you how to prepare different financial statements, inshallah. This chapter number 4 covers all these 5 topics in 3 lectures. Lecture number 1 is horizontal analysis. Then we have lecture 2 in this chapter, which is common size and index analysis. And then we have lecture 3 in this chapter, which is trend analysis. But we'll cover these 3 lectures from this chapter in 2 video lecture series, which will be lecture number 6 and lecture number 7. So let's begin with the first one, horizontal analysis and vertical analysis. Before discussing horizontal analysis and vertical analysis, I'll have a recap on what we have already studied. In our last lecture, we had discussion on the financial statements and its usages, and also we had discussion on the cash flow statement. We discussed how a cash flow statement is prepared, and we had a practical work on the preparation of the cash flow statements. So today I'll show you all the financial statements, the templates of them, and I'll share with you. If you want, you can forward me your email address. I'll share all these templates with you through that email. So before discussing those financial statements templates, let's have discussion on a topic that we have already discussed in previous chapters. It's going to be a recap. What is financial statements analysis? Financial statements analysis is basically, in simple words, if you say, it's a tearing apart the financial statements and looking at the relationships between various items of those financial statements. So it's basically tearing apart the financial statement. It means looking thoroughly into the financial statements in order to draw a connection between various items of the financial statements and find out what relationships do they have, and then reach to a conclusion based on which decision making is taken place. So who analyzes financial statements? There are 2 types of users: internal users and external users of the financial statements. So internal users could be all the people from inside the organization, especially the management and the department heads and the supervisors. They required to study the financial statements and do analysis of those financial statements in order to do proper planning in the future based on the information that they get from those financial statements after analyzing them by using different methods, of which 5 of those methods are in this chapter. External analysis. So external users. External users are stakeholders outside the organization. Those could be investors, those could be customers, competitors, vendors, government agencies, or public accountants. They are external users. They study your financial statements, analyze them, and then get information, and based on that information they take their decision based on their need and their purpose. And the most emphasis of this chapter is going to be the external users of the financial statements and how they use financial information from the financial statements by analyzing them using various methods of the analysis of the financial statements. Okay, now what do internal users use it for? Internal users use financial statements analysis methods and financial statements information for proper planning, for evaluating the results, for controlling the company operations effectively and efficiently. What do external users use it for? External users use it for various purposes. Each user has its own purpose and its own usage of the information of the financial statements. Mostly they use it for assessing past performance of the company and current financial position and making predictions about the future profitability and solvency of the company, as well as evaluating the effectiveness of the management. That's the overall purpose of the external users. But I earlier discussed that each external user has its own motive, its own purpose of using the financial information of a company, right? So usually there are 4 elements that any user would like to know about. Number 1, profitability. Number 2, solvency. Number 3, liquidity, and number 4, stability. So these 4 are the indicators of a good business. So they are usually checked by the users, whether internal or external, by using the financial statements financial information from the financial statements, by using various financial statements analysis methods, right? Okay, so let's talk about the financial statements now. I'll show you a balance sheet which is used in Afghanistan. This is a standard template for the balance sheet used in Afghanistan accounting system, right? This is issued by the Ministry of Finance and used by the taxpayers while they report their income statement and balance sheet to their tax returns, especially the annual tax return to the Ministry of Finance, to the tax office. They have to fill this template of the statement of finance position or the balance sheet. So on the top there's heading, company name of the statement, and the year. Usually in Afghanistan a comparative balance sheet is used. A comparative balance sheet is the one where we have the information of at least 2 years, previous year and the current year. So if you can see on the top, there is tax identification number, the name of the taxpayer. Taxpayer name is written down here, and the taxpayer identification number is written 1, 2, 3. Their 10-digit tax identification number is written on the top. So from here basically to here, this is the heading of this balance sheet. Then we have information of 2 years. Here we have 1 year, and here we have another year, and on both sides you can see there is English and the reversion of the items on that. So assets portion, you can see in assets we have first current assets, and these are the codes given to each current asset in the current asset portion. 10, 20, 30, 40, 50. These are the codes given to these accounts. So the first account we have is cash and cash equivalents at bank, cash and cash equivalents on hand, and this is Afghani currency. Taxpayers are required to report everything in Afghani, and values should be in Afghani. Financial investments, inventories and finished goods, other intangible assets, raw material, trade and other receivables, work in process or unfinished goods, other current assets. So other current assets are the one who have not been listed from 10 to 80 number codes. So all the remaining assets are reported under the other current assets. Now total current assets, as you can see, we have to add from 10 to 90. That will be all current total assets. That's for the current year 2018. That's for the previous year 2017. Now we have non-current assets here. Financial investments, long-term financial investments, goodwill of the company, land and buildings, other intangible assets, other receivables. Look, here we have receivables as well, but those are short-term, and these are long-term receivables which we will receive in more than 1 year's time in the future. Property, plant and equipment, other non-current assets. So here we have total non-current assets. How will we find out? Equals sum from here to here, and this is how we can find out the total non-current assets, right? Now total assets, how is total assets found out? You see here, total current assets plus total non-current asset is equal to total assets, and same is the case with this one. Now we have, this is the first portion, the left hand side of the accounting equation. Assets equals liability plus equity. So now we have total liability found. Now we will find first total assets are found. Now we will calculate liabilities, and then we will calculate equity. Then we will add up both liability and equity. The total of these two should be equal to the total of total assets. So in current liability, under liability portion, we have current liabilities, and we have bank overdrafts, borrowing, current portion, current tax liabilities, provisions, short-term, trade and other receivables, other current liabilities. Here current tax liabilities, here monthly or quarterly, or those tax liabilities that we will be paying in the future month are reported here if not paid. So this is the current portion liability, and then we have non-current portion. We have accumulated depreciation, borrowings, provisions, non-current liabilities. In Afghanistan accounting system, here on the asset portion we have to report the assets on its original value. We don't have to reduce or deduct the depreciation expenses. We have to report the assets based on the book value. Then all the depreciation is added here to this portion, to 270 code. Accumulated depreciation of all the back years is added here. For example, if there's previous year we have 100,000, this year we have for example 50,000 of another liability, depreciation, then for 2018 it's going to be 150,000, because 100 plus 150, right? But here the book values will be written same unless we have purchased new assets, so that will add up here, increase the value of the assets. Next, then we have total liability. which is current plus non-current, right? Current plus non-current. Now the last portion is equity portion. In equity we have capital, other reserves, retained earnings, share capital, other equity, and net profit. Capital is the capital invested, initial capital. Here we write initial capital. If the company has other reserves, right, we report here in retained earnings. It's the retained earning of the previous year plus the net profit of the previous year. It equals to the retained profit. So share capital, if we have issued any shares, so written here. Other equity, it's written here. Net profit, this is basically taken from the profit and loss statement, right? Net profit is taken from there. Now the total equity, will have to add up all of them, and then there is total liability plus total capital. Total equity equals to total liabilities and equities. Now this total of this is going to be, should be equal to the total of total assets. So this type of template or format is used in one sum for balance sheet. Now we have let's talk about the profit and loss statement. How profit and loss statement is used. So based on this is also issued by the Ministry of Finance, and all the taxpayers are required to fill their income statement in this format and submit to the Ministry of Finance, especially annual income tax return. So title starts from here to here. You can see this the company name, there is the statement name, the year, and then taxpayer identification and taxpayer name, and then again this is not like for 2 years. This is basically for 1 year, right? So let me merge it. This is for 1 year. Then on income statement we can report both values. On one side we can report dollar, let's say USD. On the other side we can report Afghani for the same year, right? Okay, one thing more. If you use it for the reporting purposes, then you have to report here only 1 year. But if you are using it for internal purposes, then you can report 2 years. You can prepare a comparative income statement. This column will be for 1 year, for current year, and this column is going to be for the previous year. You can report both Afghani figures instead of USD, Afghani here and Afghani here, right? But when you report to Ministry of Finance, then you have to report it for 1 year, and on one side there should be dollar values, on the other side there should be Afghani values. So in profit and loss statement we have two portions. We have first income portion, then in other we have the expense portion. Now let's first talk about the income portion. In the income portion, the first is assessable income, and the codes are given to each account. So first is gross receipts in dollar, gross receipts in Afghani. Gross receipts, any income from provision of goods and services, or from the sale of goods and services. Any money coming in to the organization are reported here. Then inventory at the beginning of the year. Then we have purchases. Then we have total inventory. Total inventory is inventory at the beginning plus inventory purchased, so that becomes the total inventory for the year. Then we have inventory at the end of the year, so that's what total inventory we have left with us. Then cost of goods sold. How cost of goods sold is calculated? total inventory minus inventory at the end of the year. Total inventory minus the inventory at the end of the year, we find out the cost of goods sold. After this, we have to find out the gross profit. The gross profit is calculated by subtracting the cost of goods sold from the total sales, right? So that's how it is done. Okay. Zero, no interest, right? Okay. Next we have is the other income. The other income is dividend income, foreign income, interest revenue, rent revenue, royalties revenue, income from sales and exchange of assets, and then we have miscellaneous income. Miscellaneous income, any other income which is not listed here. So then we are here to calculate the total assessable income. Total assessable income is the total of all these incomes plus the gross profit. You can see total of all of these plus the gross profit. Right here, Afghani figure, and there dollar figure. Now we come to the expenses portion. The expenses portion. Let's see how many types of expenses do we have. Each expense has its own code here. First expense is advertising and entertainment, bad debts, business receipt tax, 4%, 5% tax, 10%, transportation, car and truck expenses, casualty or losses expense, commission paid, depreciation, dividend, loss, foreign income, insurance expense, interest, again professional, office, repair, maintenance, rent and lease, royalties, supplies, license fee, travel, utilities, wages, and any other expense which is not listed here to here is reported under what? Under miscellaneous expense. Now total expenses, we have to add from here to here, and then profit or loss. Profit or loss, this is taxable profit, right? Earning before tax. How it's calculated? We have to subtract all the. We have to subtract all the allowable deductions or expenses from the assessable income. We'll have profit. This profit is profit before tax, right? Remember, this is profit before tax. After this, so once you have calculated the taxable profit, then you are going to apply 20% corporation tax, and then you will find out the net profit or profit transferred to the balance sheet, right? And as earlier I mentioned, in capital portion of the balance sheet, net profit is taken from the income statement after deducting the 20% corporation tax, right? So these were the profit and loss statement and the balance sheet used in Afghanistan for reporting purposes, issued by the Ministry of Finance. They're official. Now next, we have some other formats, international, as per the international standards. So here the first one we have is the statement of financial position. You can see it's for 2 years, right? First we have current assets, non-current assets are written here, and then which are 3 here, then we have current assets. So in international format, first they report non-current assets, then they report current assets, then total assets are found here by adding both of them, and here they these 3. Then we have equity and liability portion. So in international format, first equity is reported, but in Afghanistan you see first liabilities were reported. So equity portion, share capital, return revenue, revaluation reserve. So these are added, the total is found. Then Next we have liability. First non-current liabilities, then current liabilities, right? Total of current liabilities, then total liabilities, both of them are added, then total of equity and liability. So this is the international format. You can see there is comparative financial position statement. Means that there are 2011 and 2012, and they are in a standard international currency, which is USD. I can also share this with you if you want. Next we have the income statement or profit and loss statement. This also for 2 years. Comparative statement is this. First revenue, they have first cost of sales, which is cost of goods sold, and how to calculate that I earlier discussed. Then we have gross profit, then we have other income, then we have distribution cost, administrative expenses, and then we have finance cost, right? These are all the expenses. And then we have profit before tax, then income tax expense, and then profit of the year. This profit is basically transferred to the balance sheet. Then down there the earning per share is calculated, basic and diluted. Remember that these financial statements are made for corporations, for limited, for public limited companies, the companies who issue shares and bonds and has thousands of shareholders. So these statements are made for those businesses. Okay, next we have statement of cash flow. You can see it's also for 2 years. First is cash flows from operating expenses. Profit before taxation is written here. Profit before taxation, this one, right? This one. Now we have adjustments. Why they have put some adjustments here? Because there are certain expenses which are called non-cash expenses, or maybe they have been declared but yet not paid. When the payment is not made, then we have to consider them as a cash available, right? Cash has not gone out of our hands, though we have reported them as an expenses, right? But they are non-cash expenses, so we have to add them up once again in the cash flow statement to show the actual value and to show the effect of those in the balance sheet in order to show the correct value. So depreciation is a non-cash expense. We do not pay this, therefore it's added up again. Amortization, investment income also, and interest expense as well. Then we have there are some other expenses which we show which might be like we have showed them that we have paid, but they are not paid yet, right? Or we have not received yet, though we have shown them as a cash received, but we have not received them. We'll receive in the future. So that's why they are also added up. Their effect is also given here. So these are increase in trade receivables, increase in inventory, short-term borrowings. This is the money which does not belong to us. We'll have to pay back. That's why we here we have to deduct it. These are added and these are deducted, right? And trade payables. So then cash generated from the operations. This is all the cash. This is added up, and then interest paid, income tax paid, and then we have net cash from operating activities. So it's added. This one and these three are added, right? So when the money goes out, we show them in a negative figure. So here they are added. When we add a negative figure, it automatically deducts from it and shows a negative effect. Then we have cash flow from investing activities. Here we have purchase of current equipment, purchase of intangible assets, proceeds from sales and equipments, all this. Then financing activities are here. Then at the end there is net effect shown, net increase in cash equivalents, all of them are added. Then cash equivalent start of the period and cash equivalent at the end of the period, so both of them are added and you have the cash. Now this cash is reported in the balance sheet. This is how a cash flow statement is prepared. We discussed that in previous lectures. Next we have is a statement of changes in equity. Statement of changes in equity. So it's for share capital, retained earnings, revaluation surplus, then we have total equity, right? It's at the beginning, January 2011, and this is restated balances. Balance at 31st December, then changes in equity, and then balance at 31st December. You can see 4 of them are added, right? So this is how a changes in equity statement is prepared. See, all of them have been added together, and here they are added together, and here they are added together to show the net effect, right? So these were international templates for the balance sheet and for the financial statements. Now let's talk about the horizontal analysis. Horizontal analysis is one of the financial statements analysis techniques used by the financial analysts in order to calculate the dollar change and the percentage change over a period. So as you can see, the analysis is horizontal, means we compare one year information with the other year information. We go from here to here, or we go from here to here. For doing horizontal analysis, we must have a comparative balance sheet, which is containing information for at least 2 years, of which 1 year is taken as a base year, and the other year is information is compared with that. And once we get the results then on the basis of those results, the results are first interpreted, and based on the interpretation of the result, the decisions are taken. So let me show you an example here. This is a balance sheet of one of the organizations by the name of Clover Corporation. Comparative balance sheet for the years 1999 and 98. So as we can see, it's just the asset portion of the balance sheet. You can see different current assets and non-current assets here, and information is available here. Now the method of the formula used for analyzing to carry out horizontal analysis on the balance sheet is given here. If you want to find out the dollar change, what you will do is you will have to subtract the base year figure from the current year figure. And if you want to find out the dollar change, then you have to do what? You have to divide the dollar change on the base year figure and multiply by 100, right? So let me show you this, how this takes place. Let me show you in Excel. Okay, before we go to the Excel, I'll practically show you how to calculate. An example has been here solved. You can see it's the same like we have the balance sheet. Now we are carrying out the horizontal analysis. What we will do is we will prepare a table where we'll add 2 extra columns to that balance sheet, or we can say prepare another separate balance sheet, adding 2 additional columns for one comparison or for the analysis. So the first column is for the amount change, and second column is for percentage change. If there is an increase, it will be shown as a positive figure. If there is an decrease, it will be shown as a negative figure or in the bracket. So you can see here we have cash of 12,099 and 23,098. So first we have to see that which one should be the base year. Since we are measuring the amount of change between 1998 and 99, the dollar amounts for 99 becomes the base year figure. So the year which is the oldest, we usually take that as a base year. So here 98 is taken as a base year. So per formula we have to, if you want to find out the dollar change, what we will do, we'll have to subtract the dollar, the base year figure from the current year. So the current year is 99 and the base year is 98. So 12,000 minus 23,000, it's minus 11,500, which means there is a decrease in the cash. There is a decrease in the cash as compared to 1998. We have a decrease of 11,500 in 99, right? That's the dollar change. Same operation can be done for the account receivables, inventory, prepaid expenses, total current assets, land and building, and all of these figures we can carry the same operation. 40,000 minus 40,000, 120,000 minus 85,000, 106,000 minus 125,000, 315,000 minus 29,000. We'll get the results here. Simple calculation. Now the next step is to find out the percentage change. So what you will do now is we have found out the dollar change. Now the dollar change will be divided by the base year figure, which is 23,000 here. So for cash we have already obtained this one, right? 11,500. We'll divide 5,000 by 23,500 and then multiply by 100. We'll get the percentage change. So you can see there is a negative figure of 48.9%. So there is a decrease in cash by 48.9% in 99 as compared to 1998. The same operation is followed to find out the percentage changes for the rest of the items of the assets portion. You can see here this is the result. First 12,000 minus 23,000 minus 1105,000, then minus 1105,000 divided by 23,000 multiplied by 100, we get this one. Then for account receivable, 60,000 minus 40,000, we have 20,000 plus. Now 20,000 divided by 40,000 multiplied by 100, we have 50%. So 50% increase in accounts receivable. Then we have inventory, 80,000 minus 100,000. So there is 20,000 minus. So minus 20,000 divided by 100,000, we'll get minus 20%. So it means that there is 20% decrease in the inventory, 50% increase in the cash, and 40.9% decrease in what? In cash. Similarly, same operation is done for all of the line items. So this is we have dollar change and we have the percentage change, right? So how we will interpret the results now? We'll say that our cash has decreased by 40.5%, but on the other hand, you can see there is an increase in accounts receivable. So where has that cash gone? We had the sales, but cash has not been received. So you can see there is a similar decrease in increase. There is a relationship between the cash and the accounts receivable. We have a decrease of 48.9% in cash, but we have increase in accounts receivable, means we have cash on other people. Other people owe to us, they are to pay us in cash in the future. So that's how it happens. Next, inventory. There is a decrease in the inventory, means that we have sold out inventory as compared to the previous year. We have more sales. The inventory has been sold more, but that was not cash sale, but accounts receivable, cash or credit sale. Next is prepaid expenses. You can see there is an increase of 150% in the prepaid expense, means we have paid for certain expenses in advance, and that's why there is an increase. Total current assets, there is 5.9% decrease in the total current assets, and that's due to the cash, and that's due to the accounts receivable, right? Okay. Decrease is due to the cash and due to the inventory, and because of these two things we have 5.9% decrease in our total current assets as compared to the previous year, right? Now we have the other. You can see there is no change in this. Land, building, there is an increase of 41.2%, means we have increased our investment on fixed assets, and similarly the total property and plant and equipment has also increased. So now we have an example here. This is the example, right? This is for the income statement. We have sales, cost of goods sold, gross margin, operating expense, net operating expense. We have interest, net income, and all that. 2 years, base year is 98 and 99 is the current year. We have done the same operation. 520,000 minus 480,000, 40,000. Now 4,000 divided by 480,000 multiplied by 100, we have 8.3% increase, right? Similarly, the same operation from here to here. Now let's have an analysis. Now we have done the calculation. Now let's interpret. You can see there is increase in sales by 8.3%, while there is a decrease in income, net income, by 21.9%. Why is that? It's because why? Because there was increase in both cost of goods sold due to cost of goods sold and due to operating expenses. It resulted a decrease of 21.9% in the net profit as compared to 1998. So that's the reason, right? We have increase in sales, but there is again decrease in net profit as compared to 98. The reason is the cost of goods sold and the operating expenses, right? And of course the taxes and other expenses as well. Now this was an example already calculated using this formula, one applied on the balance sheet once and then on the income statement. Now let me show you how it is done in the Excel. We have it's basically a comparative income statement of XYZ company. There are 2 years information, 2010 and 2009. Base year is 2009. here we calculate the dollar change, and here we calculate the percentage change. So sales in 2010 were 900,000. 2011 2009 the sales were 800,000. So find the dollar change. I use the same formula, current year minus base year equals the dollar change. Now I want to find out the percentage change. So what I've done, we can see the dollar change, this is the dollar change, divided by the base year, this is the base year, and multiplied by 100, I get the percentage change, which is 12.5% increase. Similarly, the same operation is carried out here, you can see. Now if we see there is an increase of 13.64% in the net profit as compared to 2009. We had decrease in it's because of decrease in operating expenses and gross margin, right? So our cost of goods sold has increased by 27.08%, but we had to cover that with the operating expenses. So somehow we have covered that by 11%. We managed to decrease our operating expenses, due to which we are still in a good increase of the net profit as compared to 2009. If we were not able to control our operating expenses and it was a positive percent change, then the result of the net profit would also be negative. It will show a loss, right? Though there is a profit of 12%, but still there is an increase of 27% of cost of goods sold. But yet we had to manage. We managed to control our expenses, so that's why we were able to result in increase in net profit by 13.64%. Otherwise, due to this cost of goods sold, we would go in loss. So which did not happen in case of this example. All right. Next we have vertical analysis. It is same as the horizontal analysis, but here we go from up to down or from down to up. We can see it's vertical. So this analysis is used to find out the relationship between different items of a single year of the financial statement. For a single financial statement, each item is expressed as a percentage of the significant total. For example, all income items are expressed as a percentage of sales. It compares each item on financial statement with each other by dividing each one on the grand total amount of a given year. It shows the results in percentage only. So what is the formula? Subtotal divided by grand total multiplied by 100. Subtotal divided by grand total multiplied by 100. Remember that in income statement the grand total is the sales, and the subtotals or the rest of the items including income and expenses. In balance sheet, the grand total is total assets for the asset portion, right? And for the other equity, liability and equity portion, the grand total is total of liability and equity, and the subtotals are each item of the liabilities and each item of the equities, right? So mostly for horizontal and vertical analysis, we use the income statement and the balance sheet. The other financial statements are not used in order to apply a vertical and horizontal analysis. So let's go ahead and see how it is done. There is a company, sample company. We can see the balance sheet for 2 years, 98 and 99, right? This time we do vertical analysis. How? We divide the subtotal on grand total, subtotal divided by grand total, and then multiplied by 100, we get the percentage. So here we add two separate other items for 99 and for 98. these two columns shows percent of total assets. So we say cash, we compare the cash with the total assets. So cash divided by the total assets multiplied by 100, we get 17%. Means that 17% of the total asset is made up of the cash. Similarly, in 99, you can see in 98 there is 8%. So we say that 98 8% of the cash of the total asset what was made up of 8% of cash. Means that in total assets 8% is the portion of cash. Now we can compare these 2 years. There has been an increase of almost like 9% increase in the cash is compared to 99. You can see here, you can compare then the percentages. First we do horizontal analysis, right? We compare each item, we divide it on the grand total. Then after we have the result for both years, then we can do a horizontal analysis. We can subtract current year from the base year to find out the net effect. Okay, you can see here the same operation is carried out for all the items. 120 divided by 483,000 multiplied by 100, we get 25%. 87,000 divided by 483,000 multiplied by 100, we get 18%. Same is the case for all. Similarly for 98, 100,000 divided by 387,000 multiplied by 100 equals to 26%, right? So that's the it's carried out for all of them. Now let's see how can we do it in the Excel and practical. I've taken the same example as I used for horizontal analysis. You can see there's a company XYZ. It's the income statement. 2009 80,000 sales, and 2002 90,000 sales. Information is here. So since this is the grand total, so I have not applied vertical analysis formula on this because it will give us 0 answer. So that's why start from the beginning inventory. You can see the formula. What I've done is subtotal, which is beginning inventory, divided by grand total, which is sales, multiplied by 100. Now we have the percent, 4.7%. Then for purchases, same case. Subtotal purchases divided by grand total, which is sales, multiplied by 100. We've got how much? 70.7%. Similarly, it shows that 4.7% in total sales. 4.7% is the portion of inventory. In total sales, 70.7% is of purchases, right? It means that 70% purchases were made, and then total available good for sales is 75%, ending inventory is 7%, cost of goods sold is 6.7%. So means that out of 100 rupees that we have earned, we have paid 67.7%. The remaining is our what? The remaining is our profit, gross profit, right? Same operation is followed here. Same operation is followed for 2009. Subtotal divided by greater multiplied by 100, right? So here, if we add up these two, is how much? 77%, and then we add this one and this one, 7%. Okay, so that's how the vertical analysis is carried out, right? Subtotal divided by greater multiplied by 100, then we get the results, right? Then we compare both years. We say there is a 1% decrease in beginning inventory as compared to 2009. There is 10% increase, there is 5% increase, there is 2% increase, there is 6% increase, and there is 1% increase. See, how can we do that? For example, current year minus base year. You can see that's 0.2% increase. Current year minus base year, there is 10% increase. Right? We can do the same action for all of them, so we can see what percent has increased and decreased for each item as compared to the base year 2009. Right? So this is our vertical analysis. Please do let me know if you have any questions. And the way I have prepared an Excel, please take an XYZ company and work on horizontal analysis and vertical analysis. Apply both methods on a company's balance sheet and income statement, and then share with me your results. If you have any question, any trouble with calculation in the formula, please do let me know. I'll try my level best to get back to you as soon as possible and try to make it more simple so you can learn. Thank you so much for being with me, and that's enough for this lecture, and bye for now.